Assalamu alaikum. Hello, how are you all? Friends, hope you are doing good. I'm also doing good after a long time. So, this is the fifth video. My last video was on the stakeholder objectives and conflict. Now, building upon that, this is the fifth one, the role of management and goal congruence. So, in this video, we are going to cover 5 main things: agency theory. What are the problems of agency problems? Then we are going to cover the managerial reward scheme. This is the way how we are going to resolve the agency problems, the agency issues. We are going to solve it through managerial reward schemes. Very important again. And then we have corporate governance code. So both managerial reward schemes and corporate governance code are going to help us to solve the agency problems. And last, we have stock exchange listing. Not much is there about stock exchange listing, right? So let's begin. Agency theory. What is agency theory? You must have learned from your previous studies. F1, F1 and F1 or F3. I'm sorry, F1 or F2, right? F3 is financial accounting. Yes, so F1 and F2, you must be knowing what is agency theory and all. What is it? The reason why I'm putting all the definitions and all is for you because this will come. You have a multiple choice questions in section A. So that's why each word is very important. That's why I have put the definition as it is. I didn't change any definition from the textbook. You can go to the textbook. Everything which I'm covering in the videos are there from your textbook only. Right? This is for those students who are very lazy to read the textbook. In fact, they find the videos more interesting. So nothing is new from there. I have taken from the textbook only. So what is agency theory? Agency theory occurs where one party hires another one to perform the task on behalf of them. Okay, that is known as the principal. The one who is going to, on whose behalf the agent is going to work, is known as principal, and the one who is working, who is performing the task on behalf of someone else, is known as an agent. So in a company, the principal will be the shareholder, and the agent could be anyone, the director, the employees, right? Next, why this agency theory, how this agency theory is built up, why we have to study this agency theory is very important. You have to know why you're studying the agency theory, because otherwise there's no use of you memorizing the definitions of agency theory when you don't know the foundation behind it, how it built up. So now you know that before, in the past, the companies, everyone was a sole trader, right? Then from sole trader, it went to partnership, and then from partnership it went to limited companies, where the manager and the one who owns it are two different person. You see, because it's two different person, there's a divorce of ownership and control. Not the same person does not own and control the company. You can see, can you see that? As you can see in today's scenario, the modern world, the today's company, you see owners might be sitting somewhere else and someone else is running the company. That managers are the one who are managing the company, they are running the company, but the shareholders has the, they own it, but they are sitting somewhere else. There's a diverse of ownership and control, it's not in the same hand. So in that case, what happens is your manager, whoever you hire, right, no matter whatever salary you give, no matter whatever packages and benefits you give, still there is a chance that he or she will perform for their own self need. That's why we are studying this agency theory. Because most of the thing, when a business collapses, if you have seen the history, there are so many collapses where the business falls down. It is because of this agency theory. There are issues, problems with the principal and the agent. That's why we're studying this agency theory, even in financial management. Right? So shareholders own, managers control on day-to-day basis. Therefore, shareholders' interests are not the foremost important interest for manager. For manager, they have their own self-interest. Shareholders have their own interests, which are not the same. You see, the goals are two different goals. When the goals are different, it's harder to go hand in hand. But if the shareholder and the manager have one common goal, it's easier for them to work. because ultimately they're achieving the same objective. But whenever it's different, then it's hard. Then there are so many issues which comes later on, which we are going to study. Next, these are some examples of agency problem, which you don't have to know in detail, but at least briefly understand. Number one, remuneration. You can see even in the newspapers headings and all, you will see the excess remuneration is for the executive directors and all, the one who is in the senior position. They are taking excess remuneration, more than which is reasonable, which could be justified. Why is that? Because it's an example of agency problem. Why? Because I've told you previously, managers have the information which the shareholders do not have. They are the one who's running the company day to day, right? So they can do anything with the records. They can change, they can manipulate and get the bonuses out of it. Because of information asymmetry. Managers know more than shareholders. They have the information which shareholders do not have access to. Even though shareholders are the owners, but they don't control, they don't run. They don't manage on day-to-day basis. So remuneration, excess remuneration. Next, creative accounting. What is creative accounting? As I've told you, it is linked with the remuneration. Creative accounting means you're changing the figures, you're manipulating. You're showing that you're in a better position. Whereas the company is going in losses, being a manager, but you are showing it in terms of good light so that you get the bonuses out of it. If your remuneration is linked to the profits, short-term profits, then creative accounting is very likely to happen. Next, off balance sheet finance. All of this you can read in detail in textbook, right? I'm just explaining briefly because understanding of depth is not required, it's not necessary. Okay, so off balance sheet finance. What is off balance sheet finance? What is it? The items, the events which are occurring after the balance sheet date, which are not putting in the balance sheet, which might be needed for you to put there, or you're not disclosing certain events which needs to be disclosed or in as a note, which could be material for the balance sheet. Next, we have takeover bids, where the manager is stopping the takeover from happening, whereas if the takeover happens, it is in the best interest of the shareholder, hence it maximizes the shareholder's wealth, but manager is stopping. Why? Because managers have their own self-interest over the company's interest or the shareholders' wealth maximization. In that case, they're stopping the takeover from happening. There are various methods of stopping the takeover. For prevent the takeover from happening, which is not required at this stage for you to learn, it will be asked in your advanced financial management level. So we're not learning it here. And finally, we have the unethical activities. Because of this agency problem, all unethical activities are taking place. Right? The shareholders might not be even aware of all these problems which managers are doing. Remember, to boost short-term profit, right? Managers might take various shortcuts, right? Or they might charge prices very highly to get short-term profit, to increase their revenue in the short term. Whereas in the long term, it is harming the customer, the loyalty of the customer, or the company's image or the reputation. But in the short term, they're having the profit. Why they want the profit? Because their bonuses, their remuneration, their salary is fixed. It's dependent on that short-term performance. They get bonuses year on year. So all the unethical activities will take place. So these are the 5 common examples of agency problem. Next, we have managerial reward scheme. So what should we do to solve this agency problems from occurring, or to minimize at least, if not eliminate completely? Remember, there is no agency issues which you can eliminate completely. Yes, you can do something to reduce it to a minimum level, but you cannot eliminate it completely. Why? Why is that? Because every person, if they get the opportunity to do it, or they are pressurized to do something which they don't want to do, they will do it. If they get the chance, they will do it. Because still the ownership and the control are in two different hands. Even though you put the schemes, even though you try to take all the actions, still there are chances that this agency problem will occur. But at least it's just you have to take steps to reduce to a minimum level. Because no two humans can think the same. You cannot think alike. At least in the short term, you can make them think alike, but not in the long term. Right? But whatever. Now let's know what are the managerial reward schemes. This is very important. For your syllabus also, you have to know what are the managerial reward schemes. You might be asked to tell the advantages and disadvantages of each managerial reward scheme, and according to the case study, which one is the most suited. You might be asked a question like this, so you have to know it. Okay, there are 4 important things that the schemes should consider. What are it? Before you design a scheme, every reward scheme have to have this 4 characteristics. Number 1, it has to be clearly defined, impossible to manipulate, and easy to monitor. Now let's say you have designed a reward scheme which is very easy to manipulate. Anyone can come and change it or manipulate it. Then the manager reward scheme, the advantages will be not much. The disadvantages will be more. So you're not getting the outcome which you want to get out of the reward scheme. So you have to be very careful in designing it. It has to be clearly defined. Everyone should know. They have to be very clear. All the employees should be very clear on what they're expected to get, what they expected to do. Impossible to manipulate. It has to be such a scheme that is very hard to manipulate and easy to monitor so that you can monitor. Next, links reward to the changes in shareholder wealth. If you want to link the reward, see how much the shareholder wealth is changing. If the shareholder wealth is improving, that's a good sign. You increase the reward. If the shareholder's wealth is reducing, you reduce the reward. It's like that. Changes in shareholder, because ultimately day one I have told you what are the main objective, what is the primary objective of financial management is shareholder wealth. Shareholder wealth has to increase. That is the number 1 objective in financial management. So everything what you are studying over here is to maximize the shareholders wealth only. That's why even your reward, you have to link it to the changes in shareholder wealth. Third, match the manager's time horizon to the shareholders time horizon. Now shareholders might be thinking in long term, let's say 4 to 5 years, their reward scheme. Manager says 1 to 2 years. So you see there is no it's not common. It has to be in the same page, both of them. The time horizon has to be similar for both of them. If you're having a reward scheme, make sure that you align the manager's time horizon with the shareholders time horizon. Both has to be similar for it to be effective. Number 4, encourage the managers to adopt the same attitude to risk as shareholders. Yes, if the shareholders are such that they don't want to take much risk, but managers are the one who wants to take excessive risk, it's not a good strategy. Your reward scheme will fail. Remember that. So the attitude to risk has to be similar for both. It cannot be 100% same, but at least it has to be very much close to each other. Okay, next we have what are the reward schemes. So what are the common types of reward scheme? This you have to know. There are 3 or 4 which we are going to study today. Is remuneration is linked to profit, minimum profit level. That means if you achieve that profit level, you will get the remuneration. Next, economic value added, EVA. Your remuneration is linked to economic value added. For all this, we have the pros and the cons which we are going to study, which you have to know. Next, we have revenue growth. So your remuneration is linked to revenue growth. And then we have the second type of reward scheme is what? Executive Share Option Scheme, ESOP. We are going to study the pros and the cons of both. So next is remuneration, which is linked to the minimum profit level. What are the pros? What are the cons? Advantages. It is easy to set up and monitor, isn't it? Because it's easy to see the profit. Can't you see? if the profit increase or decrease, definitely you can see. You can compare how much was your profit last year, how much is your profit this year. So it's easy to monitor, it's easy to set up also, because minimum profit level. You define that this is the minimum profit level, let's say 10,000 UK pounds you have to achieve by this year. So it's easy to set up and monitor. Okay. But the disadvantages are managers taking decisions that will result in profits being earned in the short term at the expense of long term profitability. I've told this earlier. Short term, yes, they are more worried about making short term profit now, even though in the long term it's going to harm their profitability. So that's a disadvantage. Next, managers are underachieving. It could lead to managers underachieve. They are not going to achieve the maximum. They are not going to do their best. Why? Relaxing as soon as the minimum is achieved, because it's minimum profit level. Let's say the minimum profit level is 10,000. So once they receive more than 10,000, let's say 11,000, they will be relaxed. They don't want to go higher than that. So underachieving. Next disadvantage, the scheme might also tempt managers to use creative accounting. Remember the agency problem? The 5 agency problem? One was creative accounting was there. So this issue will come. Why? Because they want to boost the profit figure. If they boost the profit figure, they will get their remuneration. Next, we have EVA. So what are the pros and the cons? Advantages is EVA is measure of increase in value of shareholder wealth. We all know that our main objective, number one priority is maximization of shareholders' wealth. Anything which maximizes your shareholders' wealth, it's good. It's positive sign. So EVA is one of that. EVA measures that shareholders' wealth max. Unlike profit, okay, because higher the increase in profit does not mean your shareholders wealth is increasing, remember that. But if your EVA increases, economic value added, that means your shareholder wealth is increasing. Another advantage is therefore designed to more closely align the interest of employee and shareholder. That's why this scheme, it is designed in such a way that the interest of employees and shareholders are closely aligned. Because if you increase the EVA, okay, that is the interest of employee, ultimately is increasing the shareholders' wealth, which is the objective of shareholders. So both are achieving their objective. Next, disadvantages. Calculating the bonus may be complex. Definitely. For economic value added, when you have to calculate the bonus is complex. Next, we have remuneration linked to revenue growth. What are the advantages? Growth of the business and higher production level can lead to economies of scale, which in turn help the companies compete more successfully on price, because you can charge lower price. Remember, when economies of scale, when you achieve economies of scale means when you're producing large amount of production, you can now produce at a lower price compared to your competitor. You can charge at a lower price. Economies of scale. So you can compete on the price. That's what happens. Disadvantages. Revenue growth could be achieved at the expense of profitability. Yes. Maybe your profitability is being harmed, whereas you are achieving the revenue growth. How? Example I have given, reducing the selling prices. Right? Maybe you are reducing the selling price to increase the growth, revenue, or by selecting high revenue product lines which may not necessarily be the most profitable. Yes, you are increasing the revenue, but it's not so much profitable. So maximizing revenue is unlikely to maximize shareholders' wealth. Like profitability, even this one is not maximizing shareholders' wealth. The last one, executive share option scheme. What is it? Advantages. It encourages managers to maximize the value of shares of the company. Why? Because higher the value of the shares, the price of the shares, higher remuneration the managers will get. In the long term is good for the company also, when the price of the shares are high. So ultimately the company is achieving their objective, even the managers are achieving the objective. Normally this is set up over a long period of time. This is not unlike your revenue growth or profitability or economic value added. Good thing about executive share option scheme is this one is set up over a longer period of time, not short term, because we know that it's not it's unlikely that your share price will increase over the short term. Whereas if it's for a long term, yes, your shareholder prices will go up and down, it will change. Either it will increase in price, either it will reduce in price. Right? So this will have a long-term impact, positive impact if share prices goes up. That means you will invest in positive return projects. Next, disadvantages of ESOP. Efficient managers may be penalized at times when share prices in general are falling. When share prices are increasing, good. Managers are rewarded. What happens when the share prices falls down? Share prices will be penalized. Managers will be penalized. Even if the managers are efficient, they will be penalized. Even though the share price falling and going up is not in the hand of the manager, they cannot control it. It is something outside the control of the managers, but still they'll be penalized. Penalized means their remuneration will be less because share price fell down, because their remuneration was linked to the share price. Higher the share price, higher the remuneration. Lower the share price, lower the remuneration. You see how it works? Now there are some criticisms of this model. The share options. You have to know this criticism, because sometimes they might ask you to suggest a efficient remuneration scheme for a question. That time you have to see the pros and the cons and decide on one, which one is the best. So number one criticism is when directors exercise their share options, what happens? They tend to sell the shares immediately to cash in on their profit. What happens? When they exercise the share option, they sell the shares. Exercise the share option means now they're getting the shares in their hand. So once they get the shares, they sell the shares. Why? Because when they sell the shares, they get the cash. So unless they are rewarded more share options, their interest in the share price therefore ends when the option exercise date is passed. Exactly. So they will only want to increase their share price up to that date, up to that exercise date. After that, they will not care about the share price, whether it falls down or goes up, because the date when they can exercise has passed. Until that date, they will care. So that's a major criticism of ESOP. Next, if share price falls when options has been awarded and the options go underwater, okay, and have no value, they cannot add as an incentive. Yes. So that time they cannot add as an incentive to the manager. You're giving share option scheme, but if share price falls, it will not add as an incentive. If a company issues large quantities of share options, there could be some risk of what excessive dilution of equity interest of the existing shareholders. What does it mean? It means you are giving large amount of your shares or share options to your managers. What happens? What happens? The managers will become the shareholders in that company. They will become, when they exercise their share option, they will become the shareholders. So what happens? Excessive dilution means your control, your ownership will reduce in that company. You being a shareholder, existing shareholder, their control will reduce. Let's say you have 90% shares in that company. Now you are issuing. So it will fall down to 80%, 70%. Depends on the number of share options, how much share options you are giving. So managers also will become a shareholder in that. That means your interest, your equity interest is diluting. Dilution means reducing. Okay, so as a result, what happens? It has been suggested that companies should recognize the cost of share options to their shareholder. There's a cost of giving these share options to the shareholder. That has to be recognized before you give this executive share option scheme to your managers, by making some form of charge for options in the statement of profit or loss. Yes, shareholders can have some charge. They will charge. Yes, they will give you the executive share option schemes to the employees, to the managers, but for that option, they will take some charge. The shareholders. That could be done. Next, directors may distort the reported profits, which is known as creative accounting, to protect the share price and the value of the share options. Yes. Because I told you, In this scheme, they want to increase the share price. So to protect that share price, they will distort the profit. They will show the different profit, which is not the actual profit, which is not as creative accounting. Again, accounting problem. Next. So we are done with that. We are done with the criticism. Now we have a question on managerial reward scheme. Let's see what type of question is this and what is the answer to this. So this is the question. Greatest Inc. INC. The INC means a company which is operated overseas. Okay, it's an overseas company. A listed company has developed a highly successful new product and is thus growing rapidly. However, with the growth, the firm is experiencing cash flow problem. So managers are currently awarded bonuses if there's a growth in reported earnings per share, EPS. Now, comment on the current remuneration scheme. What is the current remuneration scheme? They are giving bonuses based on growth in EPS. So when they tell comment on the current remuneration scheme means you have to give the advantages and disadvantages of that scheme. Okay, so let us give us the answer. Advantages. What are the advantages? What could be the advantages? You can think, write the answer and then compare your answer with this. If your answer is matching with the answer which I'm going to give you, that means you have understood it very well. If it does not match, don't be sad. You don't have to feel sorry, right? Go over it again until you get it. Okay, this is a learning process. We all are learning. In fact, I'm also learning. You don't have to be perfect. Remember, every answer which you're going to do, every question which you're going to do, your answer should not match perfectly. It will never match perfectly. Important thing is whether you have understood the concept or not. That's the most important thing. That's it. So the advantages is, one is advantages is goal congruence. How? There's a goal congruence. How is it? Managers will work to achieve growth in EPS, which will make shareholders feel that their wealth is increasing. Because growth in EPS means so managers will increase their EPS, hence shareholders' wealth also will increase. So the goal is same. It's more aligned, the managers and the shareholders' goal. The next advantage is the figure is difficult but not impossible. Okay, to manipulate. See, it's not impossible, but it's difficult. It is difficult but not impossible. That means there's a chance, slight chance of manipulating the EPS figure. Right? As it will be audited. To manipulate from one period to another. You can manipulate, right? Let's say your EPS is 5%. Slightly you are going and changing it to 10%. Right? It's possible that you can do it. So what are the disadvantages? Disadvantages are there's a little incentive for managers to control the working capital and cash flow. They have told you that they are facing a cash flow problem. So with this, right, the bonus is linked to EPS. So they will not have any incentive to control the cash flow or the working capital. Why? Because the remuneration is not linked with cash flow. If the remuneration was linked with cash flow, if the bonuses was linked with cash flow, then they will have an incentive to control the cash flow. But now they don't have it because it's linked with EPS, earnings per share. Earnings per share has nothing to do with cash flow. Right? So cash flow, working capital, they will not have an incentive to control, which is a pressing problem. How can you say, let me go back and show you. Just check in the beginning, in bold, firm is experiencing cash flow problem. It's growing rapidly, correct, but it's experiencing cash flow problem. So when it's experiencing cash flow problem in this condition, it's you have to control the cash flow. You are forced to control the cash flow, but because of this remuneration, you don't have that incentive because you're getting the remuneration based on EPS. So why will you control the cash flow? Right? So now the growth may be at the expense of liquidity. Working capital cash flow problem issue means liquidity position is being harmed. Because when your cash flow position is not good, what happens? Liquidity. You will not be able to pay back your debtors on time. So that growth in EPS is at the expense of liquidity and ultimately compromise the firm's future survival. Yes, because we all know that lack of cash flow is the reason why firms fail, why they don't survive. Even currently they might be able to survive, but in future they will not survive with this incentive, with this reward scheme. Next, managers may gain bonuses simply because of the product's concern rather than their own effort. Yes, they don't have much to give their own effort. A target growth in EPS would be better. Next, long-term shareholder wealth and EPS are not well correlated. You have to understand this properly. Whenever a reward scheme is there, right? Please understand whether it is correlated with long-term shareholder wealth or not. If it's not related, then that reward scheme will not be a good scheme. But if it is related, then that reward scheme is a good one. That's how you differentiate. That's how you know whether the reward scheme is good or not. Here it's not related. Well correlated. And if you see the disadvantages also, advantages were 4, but disadvantages are 4. Advantages were 2, I'm sorry, disadvantages are 4. So your disadvantages are more. It clearly shows that this reward scheme is not a good scheme. So there is only one measure that focuses on final effort rather than operational costs. Earnings per share. This does not care how operationally how you are performing, functioning. That's why even if you have a cash flow problem also, the company, it is being shown in a good light. Why? Because they only care about earnings per share, only one figure. Now let's move on to the corporate governance code. This is the last section of this video, corporate governance code, how we are using this to solve the agency problem. Even in SBL, we are going to study this in detail. So the director shareholder conflict has been addressed by requirements of a number of corporate governance code. Non-executive director, we are going to study two things here. One is non-executive director, the other one is executive director. Non-executive director, what are they? What are the advantages of having them? What are the disadvantages of having them? All we are going to cover. We're going to cover all this briefly. So non-executive director, important presence on the board. Their presence are very important on the board. The non-executive director. Every company should have non-executive director on the board, especially for a listed company. Next, must give obligation to spend sufficient time with the company. Yes, every non-executive director, you have to spend sufficient time. Third, so these are some characteristics of non-executive director which has to be there. Should be independent. There is no choice. Remember, no flexibility. It is a condition that you have to be flexible, should be flexible. This only comes for non-executive director. Remember, not executive director. Okay. For executive director, we have this characteristics. These are the requirements. Separation of chairman and chief executive officer. Both have to be separated. The chairman and the CEO. Submit for re-election. Executive director cannot be same executive director for 10 years or 5 years. They need to be re-elected. Clear disclosure of financial rewards. Executive director are the one who works in the company. They have financial rewards. That's why there has to be a clear disclosure of that financial reward. And outnumbered by the non-executive director. Now, let's go NED, non-executive director. Let's go in depth. So, non-executive director, at least half of the member of the board, excluding the chairman. Remember this, excluding the chairman should be what? Independent. At least half. That means 50%. That's at least. The number could go higher than that also. You could say that 60% of non-executive directors are independent, which is very good. But if it's the other way around, if it's 40% non-executive directors are independent, then that's not a good. Because they told at least half, so the minimum is 50%. These are directors who do not take part in running of the business. So who are non-executive director? If a question asks you, they are the one who do not take part in running of the business. They attend board meetings, provide advice. So these are some of the jobs which they do. What do they do? Attend board meetings, provide advice, listen to what is said, and are generally meant to act as a control on the actions of executive director. So these are the one who controls the actions of executive director. It's like they are watchmen, they are guarding, they're watching over the actions of executive director. Remember that monitor in the class we used to have? Our teacher used to appoint one monitor always in the class. Why? That monitor's job was to monitor us, how we are performing, and at the end, they will give a report of our behavior to the class teacher. So that is the same role of non-executive director in the company. They are the monitor. They monitor us, the executive director. That is their job. They provide advice when needed. They listen to the non-executive director. So that's why they have to be independent from the business. So independence means they are free of any business or other relationship. They should not have any relationship or financial interest in that company where they are the non-executive director, which could materially interfere with the exercise of the independent judgment. Why? Because non-executive director, they have to give independent judgment. So if they have any relationship in the business, what happens? Do you think they can give independent judgment? No, they cannot, because they will be materially they will be affected. It will interfere in their exercise of independent judgment. They'll be influenced. So both should disclose in the annual report which of the non-executive directors are considered to be independent. That has to be disclosed. There might be so many non-executive directors, but not all the non-executive directors are independent. Remember that. Next, non-executive directors should get extra fees. Why? For chairing the company committees, but should not hold share options in their company. So all that previously which we studied, the managerial reward scheme, giving executive share option scheme. Remember, the word executive was given there for a purpose, because that share option scheme you can only give to the executive director, not to the non-executive share directors. They cannot have shares or share options in the company, but they have to get the extra fees, right? No one will do anything for free, right? So they're looking after, they're giving an independent judgment, they need to be paid for that. So that extra fees they are going to get. There was concern that allowing any deals to hold share options in a company could encourage corporate excess or wrongdoing, right? There are some concern that if they do give share options to NADs, what happens? This will encourage corporate excess or wrongdoing. Yes. Next. Because if non-executive directors are given the share option, then who will look after the executive directors? Right? So that's why they have to be independent at any cost. One of the independent non-executive directors should be appointed as a senior independent NED and would act as a champion for the interest of shareholders. They are the one who works for the interest of shareholders, the non-executive director. Prospective NEDs should conduct the due diligence before accepting the role. Before they become the non-executive director, they have to conduct this due diligence. They should satisfy themselves, right? Remember, not anyone can be non-executive director. To have non-executive director, you have to satisfy certain criteria. What are they? You have to have the knowledge, you have to have the skills, you have to have the experience, you should give time to make a positive contribution to the company board. So knowledge, skills, experience, time, all these things have to be there and given by the non-executive director. The prospective, the one who is yet to become non-executive director. All this, what we are learning till here, whether it is managerial reward scheme, non-executive director, what are they trying to achieve? Their main goal is one simple thing. They are all helping to reduce the agency problem. They are all trying to maximize the shareholders' wealth. Next, the last one. On appointment, the NED would also undertake that they have the time to meet their obligations. Company nomination committees would examine. There are 4 committees. which we don't have to study, right? But for your understanding purposes, let me tell you the four committees which are there in a listed company, which in depth you will study in SBL, Strategic Business Leader. Nomination Committee, Risk Committee, Audit Committee, and one more is there. I kind of forgot. Nomination, Risk, Audit, Remuneration Committee. So these are the four committees. Nomination committees are the committees which hire candidates. They're the one which hire people, right? So non-executive director will be hired by nomination committee. So company nomination committee would examine their performance. They will see the non-executive director's performance and make an assessment of whether they were devoting enough time to their duties or not. They will check, are you, being a non-executive director, are you giving enough time to the company or not? Are you fulfilling the duty which is assigned to you? Coming to executive director. Executive director, the chairman and the CEO role should be separate, right? CEO should not become the chairman of the same company. That means CEO and chairman, both of these roles are different roles. They cannot be handled by one person. They have to be handled by two different persons. CEO and chairman have to be two separate persons. Why? Ask this question. Why is that? Why it has to be said? Why one person cannot do? Because the role of the CEO and the role of the chairman are two different jobs. Plus, if you are becoming if you are a chairman and also a CEO, your jobs will be too much demanding, too much to do. And also, you will have that control in one hand, which is not good. You can dominate the company according to your wish. You can manipulate. Remember, one person, when they get excessive control, excessive power in their hands, what happens? That's why CEO and chairman, two different person in the same company, right? In the same company, in the different company, yes, you could be chairman in one company, you could be CEO in some other company, different company, but not in the same company. The chairman should be independent at the time of the appointment. When they are being appointed, they have to be independent. Note that the effect of this combined with the point about independent non-executive director making up at least half of the board will be to place independent NEDs in the majority of the board, right? When we are placing the independent NEDs in the board, majority of them have to be independent non-executive director, because chairman will only be one, right? Next, all directors should submit themselves for re-election. At least you have to know the time, memorize it. Every 3 years. Every 3 years. There should be a clear disclosure of directors' total emoluments and those of the chairman and the highest paid UK director, highest paid. You have to disclose it. Both should set as their objective the reduction of directors' contract period to 1 year or less. Right? Because if the same director is there in the company, they become familiar with the company, how they operate, and also it's easier for them to manipulate. They know all the rules and procedure. So they can play around. That's why it is better for them to reduce the contract period to 1 year or less. That's why this re-election is happening after every 3 years. Now I have come towards the end of this video. Stock exchange listing requirements and other regulations. What is it? You have to know that adherence to the principles of corporate governance good, all what we studied in non-executive director, executive director, it is voluntary. Voluntary means it's not compulsory. It's your wish, voluntarily if you want to do. But they are often referred to in the listing requirements of the stock exchanges. That means if you want to get a listing in the stock exchanges, you have to follow all this. There it's a must. That's why this is done by the listed company. You have to have the executive director committee. You have to have the non-executive director, at least half. All these are required for the listing requirements of stock exchanges. Even though corporate governance code itself on its own is voluntary. This you have to understand. Okay, so with this we have covered the agency theory, how to solve the agency problem through having non-executive director, then managerial reward scheme and all those issues. The next topic will be measuring the achievement of corporate objectives, how we are going to measure the achievement of those objectives. So that's it, and see you in my next video.